With market volatility picking up and investor sentiment continuing to crash, this week we're going to lay out some probabilities and parameters to be emotionally prepared. So I get the question a lot, why, if we're just to be long-term investors and stay the course, why even do any analysis? And of course, there's always room to do some moves on the margin. And if you're a client of the firm, you know of some of the trades that we made this year. Again, certainly being first and foremost process driven, but that process certainly being influenced by our look at the markets and the probabilities of what might lie ahead. But the other big reason is just to be emotionally prepared for what's possible. I've used the analogy before. When you know you're going to hop into that lake early in the summer and it's going to be a little bit chilly, you may shudder. It may not be perfectly comfortable, but it's not going to be too shocking. You flip that around and you've just been laying on the beach collecting sun and somebody surprises you with that cold bucket of water. That's an entirely different experience, even if the water was the exact same temp. So setting those expectations are important to avoid those surprises and being emotionally triggered into, again, making decisions that would not be in your best interest long term. So with that, and with the market having a really tough Friday, wanted to walk through some of the different technical, fundamental, quantitative things we're looking at to give you an idea of what might lie ahead to, again, be prepared. On a technical level, we've talked about this. If you've been a client of the firm, you've gotten this information a little ahead of time, as you should. But we said earlier in January, hey, look, we think Q1 and Q2, the first half of this year, could be very challenged. After a great run to our portfolios in 2021, thought it was prudent to rebalance, take a little bit off the table as a matter of course anyway, and then set some levels, saying, 42's very probable, 4,000's actually even still probable levels to visit, and sure enough, the market, with plenty of whipsaw, is hitting those levels one by one. What should you do with this information? Again, be prepared. If you've been rebalanced, if you had the discipline to sell some when things looked all clear and the skies were blue, good for you. You've got some dry powder to put to work. But in any case, just again, understand that if we do hit that type of level on the S&P, sentiment, which we'll get to in a minute, is going to be even worse. The headlines are going to be even scarier. You're going to feel what people always feel near bottom, which is this is just never going to end. And of course, inevitably, every season passes. Fundamentally speaking, some key things to look at in terms of leading indicators, because again, the big question we really need to solve for as to whether or not this is more probably a correction or a true prolonged bear market is, are we going to have a recession right now, or are we in a recession right now? And by all fundamental indications, the answer to that is no, we are not. For one thing, the labor market remains very tight. Usually you start to see a lot of slack in the labor market, when in fact jobless claims are at levels not seen since the 1960s, when the population was half what it is today. Unemployment rate itself remains near historic lows. The other thing you see is trouble in the bond market. And this is one of the things that made us a little bit nervous back in January, was just how tight some spreads have gotten, anticipating they might widen. That did in fact happen, but they didn't widen to a point. Credit, higher risk stuff versus treasuries is really what I'm talking about, the difference in rates. Or with respect to the inversion of the 10-2s, none of those have happened in such a way that would be reminiscent of other times that led to a recession. Perhaps most importantly is the Conference Board's leading economic indicator survey, only 0.1% off the all-time highs. Again, this is something we usually see roll over in a pretty meaningful way leading up to a recession. It's also important to say that while these indicators still don't signal a recession, even when they do, markets typically can have anywhere from 6 to 18 months of continued runway to move forward. Another fundamental data point that obviously came out a couple weeks ago, but it's worth noting given everyone's fixation on inflation and rates, was core CPI. Again, beginning to moderate. We've said we anticipated that being sustained through 21. It was likely not to abate too much in the first half, but more so in the back half. There's still a very good chance that is in fact going to play out. Quantitatively, and jumping off inflation to why that matters is rates. If you look at the weekly commentary associated with this video commentary, you're going to find a great article from Brian Westbury of First Trust where he talks about, if you're looking at monetary policy and whether it's getting too tight, that's signaling the end of an economic cycle, you certainly look at interest rates, but you don't look at interest rates alone. You also need to look at monetary supply. And if you look at the monetary supply, in modern history, it had grown pretty steady at 6%, even up and through the great financial crisis while rates dropped. However, in 2020 and since, monetary supply has been growing at over 18%. And so very liquid, very loose. Yes, rates are tightening up, but viewed in totality, still not the type of monetary backdrop that you would expect to end an economic cycle at this point. Investor sentiment, this is probably one of the key contrarian indicators that I look at most. Current AAII sentiment is at just 16% bullishness. That's actually below the level seen throughout most of the great financial crisis. Below, again, other similar points, Q4 of 18, COVID crash of 20. Those were not the beginnings of bear markets. That's not the signaling of a top. It's more often the signaling of a bottom. The market, again, as the old adage goes, is going to do what's ever going to hurt the most people, i.e. go against their position. And right now, people are positioned for the worst. So in summary, yes, corrections are painful. We're sitting down somewhere around down 14%, about average for a correction. Those bear markets we all live in fear of come with recessions. In that written commentary, you can Google this as well. The minds at Goldman Sachs say they think a recession is very unlikely. We look at the fundamental indicators, quantitative indicators that normally signal a recession. They're just not there. So while the fear associated with the recession may be there, the data isn't. And we, again, want to stay data-driven, not emotionally driven in our process. Thanks as always. Just boring analysis.
It's not boring, Tim. It's really super important. And
Jake tells me it doesn't even matter, and it's all about planning.
you just told me it doesn't even matter?
This whole day I spent on my analysis.
Just told me it doesn't matter.
When did I say analysis?